Hello and welcome to FT Markets. December is normally the quiet month where we wind down to the end of the year, think about what's going to happen next year and catch up with clients and old friends. However, the central banks aren't going to let us go quietly into Christmas. Ahead of the ECB meeting today, we face different prospects for what might be happening in Europe, and then this comes ahead of the Fed, who may be doing something very different in the US. To help us think through what might be happening and some of the consequences for markets, we're joined by Charlie Diebel, Head of Rates for Aviva Investors. Thanks for joining us, Charlie.
How are you?
Well, so I think first let's think about a little bit of context for where we've come from and where we are.
Certainly.
I think you've got a first chart here of sort of the long-run picture for sort of base policy rates around the world. So what are we looking at?
Well, as you can see, we have a period going back all the way to when most people in the markets were still in nappies, and maybe before that even. And you can see, the volatility that you experienced in interest rates back then compared to the modern era where you've had a very sustained and long-term period of close to zero. But you can also see various examples of divergence, and that's where you had differing economic cycles. Good example is, for example, in Germany with reunification, you saw their interest rate policy going in completely the opposite direction to the US because they were in a very different macroeconomic situation. And that's kind of where we find ourselves now, with Europe looking towards rate cuts at the meeting today, and obviously a very different picture from the US in a week or so's time.
Yes, so you can see here no rate cut in the US for sort of the last 9 years. But then if we go to the second chart, we can see some of the divergence which we're hearing a lot about between Europe and the US. So here we have the dollar versus the euro, and then we have the spread between the different 2-year interest rates on the bonds and the treasury.
Absolutely.
So what is this telling us?
Well, you can see how when the difference is particularly strong in favour of the euro, i.e. interest rates are a lot higher, you've tended to see the euro strengthen. And exactly the opposite, when the interest rates are in favour of the US, it tends to strengthen. Now, because this is only 2-year rates, it's within the policymaker horizon, if you like. So we can be pretty sure that over the next 2 years, you're going to see more than one rate hike from the US, even if it's a very truncated cycle. And we're still in the process of seeing further easing from the ECB. So this is not only going to drive potentially the spread between the two bond markets wider, but it's also going to keep a lot of pressure on the dollar to strengthen from here. Now, that's interesting because that tightens monetary conditions for the US, and that is one of the reasons why we wouldn't be looking for too much of a strong cycle from the US.
So as you're sort of looking at rates for Aviva and you're thinking about the market impact, I mean, so what are the consequences then for this divergence?
Well, again, a lot of the opportunities across market, and also, you are seeing different curve dynamics. For example, when central banks are raising rates, you generally see a fairly strong flattening at the long end of the yield curve because people are looking at the inflation prospects being curtailed.
So that's short-term rates going up and long-term rates coming down?
On a relative basis, they may both be going up, but the long rates move a lot less than the shorter rates.
So the shape of the curve changes.
The shape of the curve changes. So that's one of the core positions that we're looking at in the US at this point in time, in various expressions, not just in the US curve. We're also looking at some other opportunities in related markets, for example, in Mexico, which we anticipate following the US in terms of their rate cycle. And you also have quite a steep curve there, so it's a good valuation opportunity.
So you would do the same sort of curve flattening in Mexico as well?
Yes, exactly. The opposite is in Europe, where they're still cutting rates, and that generally tends to steepen the curve because, again, the strongest move is felt at the front end. And there's some good opportunities, particularly in forward space. So a curve steepening trade, but not out of the current level, but let's say move it forward 1 or 2 years.
So what would be a good example of a curve steepening trade in Europe too?
Well, one that we're looking at the moment is a 3-year, 10-year, 20-year trade. So that's effectively sort of in nominal space, looking at a 5-year versus a 30-year bond, more or less. But that tends to carry very well at this point, has good roll down, so you earn a lot of return, if you like, as the trade gets older. But it's also quite attractively priced and quite steep at this moment in time. So those opportunities, particularly set against the US, you can have this nice blend of almost compare and contrasting type trades. And that's the good thing, if you like, about having divergent monetary policy.
Well, thank you very much, Charlie.
Pleasure.
And so it seems as we finally get some major divergence between the world's important central banks, it seems like in fixed income markets at least, there's going to be a lot more interesting things to do.